Assalamu alaikum folks. Islamic mortgages are one of the most divisive topics when it comes to Islamic finances. So we've decided to do an A to Z guide covering everything you need to know in one video. For those of you who are new to the channel, I'm Ibrahim Khan. I was previously a lawyer in the city and then spent some time studying Islamic studies through a master's in the traditional route as well. And over the years, I've been sad enough to read through all of the contracts for Al-Rayyan, Gatehouse, and some of the other banks. And we have analyzed them extensively on our blog, and the link to that is in the description below. And over the last 6 months in particular, through IFG's investment arm, Curate Capital, we have actually started a fund that invests as an investor in Islamic mortgages. So we've actually seen for the first time how the whole thing works from under the hood as well. So in this video, I wanted to share with you absolutely everything that I have learned from both sides of the table as someone who is investing in Islamic mortgages, as someone who has got an Islamic mortgage, as someone who covers Islamic mortgages, so that you can make an informed decision about one of the most important financial steps of your life. The video will incline a little bit more towards the UK scene, but the theory of it is applicable to pretty much every country, and we will make a nod towards, in particular, the Middle East and the USA as well as we go along. Of course, the Sharia itself doesn't change. In this video, we're going to cover what are the different types of Islamic mortgages and how do they work, why Islamic mortgages are indeed Islamic and the common arguments against them and what we make of them, what are the current options out there in 2023, and finally, what are the usual requirements to qualify for an Islamic mortgage. Stick around until the end and you'll learn exactly what you need to get one. Let's dive in. Now, broadly speaking, there are 3 types of Islamic mortgages. Number 1, murabaha-based mortgages, 2, musharaka-based mortgages, and 3, ijara-based mortgages. The first type is a diminishing musharaka-based Islamic mortgage. This is the standard Islamic mortgage, and for residential mortgages, this is almost always the structure that you will see certainly in the UK. It is also known as the Home Purchase Plan, or HPP. The HPP is a regulatory structure that was specifically created through legislation to assist the Islamic finance industry in being able to provide an Islamic alternative to mainstream mortgages, whilst not being penalized from a tax and regulatory perspective for the differences. The way it works is there's a buyer, let's say you are the buyer for example, and in essence, you're getting into a partnership with the bank or finance provider. So for example, you put down a 20% deposit on the house. Therefore, you own 20% of the property and the bank pays the rest of the 80%, and therefore they own the rest of it. And over time, you plan to buy them out slowly by paying them lump sums to own more and more of the house, and all the while, you also pay rent in proportion to the amount that the bank owns for you living in the house. This is because, of course, you don't own all of it, so it's only fair that you pay the rent on the portion that the bank owns. And every quarter, you are slowly increasing the amount of ownership that you have in the house, and so that means that your monthly rent slowly goes down. The rent is how the bank makes money here. This structure is perfectly permissible, and scholars agree that musharaka-based arrangements are halal. Murabaha-based mortgages are the big other alternative. They're pretty simple. Here the bank will effectively buy the house of your choosing and will sell it to you at a markup. So for example, say the house you want is worth $300,000. The bank will buy it for you from whoever is selling it, and then the bank will sell it to you for $375,000 over the next 25 years. So the benefit that you get is that you don't have to fork up that $375,000, and the benefit the bank gets is that they've got a bit of a margin on top of whatever the house was worth. They know that you're going to pay that back slowly over the years. This kind of mortgage is sometimes used in commercial property finance structures by the Islamic banks in the UK, such as Al-Rayyan, Gatehouse, Al-Ahli, BLME, QIB, and others. And they also will use these structures occasionally in buy-to-let mortgages as well. So you won't find this type of mortgage widely available in the UK for residential mortgages, but you will find it used very often for residential and commercial mortgages in the Middle East, in Malaysia, and all over the world. And folks, if you're wondering why would one go for one approach to another, there's usually two reasons. The first is due to tax. So in the UK, murabaha-based mortgages don't get as preferential a treatment as diminishing musharaka mortgages. And then the second reason is usually because of custom and how everything has been set up in that country already. And the Middle East and Malaysia are often more favorable and comfortable with using the murabaha approach. Whereas in the UK, there isn't that inclination because of the unique circumstances in the UK. So finishing off on murabaha mortgages, again, they are seen as completely acceptable by Islamic finance scholars. And the way that it works is that the markup is basically seen as a profit that has been made by the bank. Ijara-based mortgages are similar to the interest-only conventional mortgages that are available on the market. Here, you pay rent on the portion of the house that the bank owns until eventually you either decide you're going to buy out the bank entirely, or you decide to sell the property and everyone gets paid off however much they are owed. So again, to run you through an example, imagine you paid 20% deposit on a house and the bank pays 80%. Here, you aren't trying to buy the bank out in installments. So instead, you just keep paying that rent on that 80% that you're using until the time comes when you can either buy the bank out entirely or you sell your 20% onto the market and everyone exits the property. In the UK, you will typically see musharaka mortgages, while in the USA, it is the same. There is another variant of the ijara mortgage where the rental payments are actually increased such that you end up paying basically the value of the house through the rent. And in the end, the bank can transfer over the freehold title of the house to you in a separate agreement for a very nominal amount. This is a popular structure in the Middle East along with the murabaha structure, but you won't see it so much in the UK or in the USA. Now you've heard all of that and you think, okay, Ibrahim, you make a pretty plausible case, it all kind of makes sense, but why are all these people who are so vehemently against Islamic mortgages saying what they're saying? What are the issues with Islamic mortgages? Well, let's look into that. So folks, we've looked at the three main types of Islamic mortgages out there. Let's outline some of the common concerns that crop up with regard to Islamic mortgages. Firstly, people say they're too expensive. Secondly, they say the documentation and legal structure is basically the same as a conventional mortgage, so what's the difference? Thirdly, they say, why does an Islamic bank point to the base rate or SONIA? Aren't they just then basically using interest and calling it something else and selling it to us? And don't worry, if you didn't understand what those terms meant, we will go into that very shortly. Here are the reasons why we, in our humble opinion, don't think these are the real issues. Concern number one, they're too expensive. This is the most popular complaint about Islamic mortgages. Not so much in the UK and Middle East, I guess, but certainly in the UK. But what people don't realize, however, is that they're comparing apples and oranges. You are comparing a multinational juggernaut, that is the conventional mortgage industry, with a clientele of around 60 million people in the UK and a centuries-long history with an Islamic bank, a fledgling company in a fledgling industry founded just over a decade ago with a clientele of about 2 million people. It's just not comparable, is it? Any new company has startup costs associated with it, especially one that is one of the pioneers in a new industry that is still testing out different products and mechanisms. All that costs money. Then you have the added problem that the current regulatory framework is entirely designed for an interest-based bank. Did you know that in the UK, only one full banking license has been given out for 100 years? That is how instinctively suspicious regulators and veteran bankers are to new players joining their party. And so you can imagine how suspicious and confused they are when confronted by a completely different model of banking, such as Islamic banking. So the biggest core reason why Islamic banks are usually more expensive than a conventional bank is that their source of funding is different. HSBC and Barclays can effectively get billions in free cash from their current accounts and savings accounts that we put with them, as they are massive banks. But in order for a niche bank like an Islamic bank to attract savers to it, they need to offer attractive saving rates. But when they do that, that means that the price of their mortgage is pushed up higher than other people. Now, you combine that with the fact that an Islamic mortgage is a niche product in a sea of mortgages. And just like if you buy a niche clothing brand, it typically is more expensive. So too will be Islamic mortgages. There just aren't as many customers for them to serve, so they do need to charge a little bit more on the ones that they do have. Having said all of that, folks, can Islamic mortgages become cheaper than they are right now? Absolutely. As I mentioned earlier, we've actually teamed up recently with a company called StrideUp, which is an Islamic mortgage provider, to finance some of the Islamic mortgages through our investment platform, Curate Capital. And so we've properly come to understand this market from an investor's perspective. And our goal behind this whole project was to rather ambitiously see if we can drive down Islamic mortgage prices to the top end of mainstream rates over the next 5-10 years. But even we know that we are not likely to ever compete with a Halifax or a NatWest, because Islamic mortgages are just going to be more expensive than the cheapest on the market. But if NatWest are at 4% and Virgin are offering 5.5% and Gatehouse is offering 7%, we like to think that over time we can drive down Islamic mortgage rates to be at the top end of the mainstream, i.e. somewhere like Virgin 5.5% as it is right now. So bottom line, folks, Islamic mortgages are not cheap, and for good justifiable reasons. Can they be cheaper? Yes, but it'll take time and concerted effort, and we need to scale the industry and sell Islamic mortgages to non-Muslims too. That means the products themselves need to speak for themselves. Concern number 2, Islamic mortgages and conventional mortgages look basically the same on paper. Some people have complained that Islamic bank contracts are nearly the same as a conventional mortgage contract, and just the word interest has been replaced with profit rate. But when you compare the legal structures against each other, they are actually very different. In an Islamic mortgage, the buyer enters into a partnership agreement with the bank and a rental agreement as well, along with a number of other supporting agreements. In a conventional mortgage, on the other hand, the primary agreement is that of the secured loan, along with various supporting agreements. The primary object involved in both approaches is to finance someone's purchase of a house and to provide the bank with sufficient protection for their loan/investment. So it is unsurprising that there is a degree of overlap. I agree that it is a bit off-putting for the uninitiated that the same wording is being used, but it is actually very standard practice in the legal contract world to work off templates and past contracts. This is done for really simple reasons. If a past contract has been successful and perhaps even been scrutinized at court and withstood that scrutiny, and everyone in the market understands it, then it is a good idea to model off that rather than write something entirely from scratch. And given the centuries of perfecting that have gone into the conventional mortgage contract, one can understand why Islamic bank lawyers borrow phraseology and templates from them. This, however, is an area for Islamic banks to look to develop, if only to improve customer perceptions. This is why we need more of our educated, aspirational youth to be engaged in the Islamic finance industry, be it from a legal, financial, shari'i, or accounting perspective. Concern number 3, Islamic banks peg their rates to SONIA or the base rate, and so they're just disguising interest. SONIA stands for the Sterling Overnight Index Average. Previously, we had something called LIBOR, which SONIA effectively replaced. And it's the rate at which banks borrow from each other. Yes, banks borrow from each other. So Islamic banks are operating in a regulatory system that is designed for conventional banks. And believe you me, conventional banks speak to each other and interact with each other all the time in the background. Part of this regulatory framework stipulates that banks must advertise their products in a way that makes them comparable to other products on the market. So all other banks and central banks use SONIA and the base rate and conventional interest rate terminology to explain their pricing and explain what they're up to. So it makes sense for Islamic banks to do the same thing to avoid confusing their customers, regulators, and also the huge array of mortgage brokers they work with day to day who don't understand too much about Islamic banks in the first place, let alone an Islamic bank that is now using entirely new terminology. This does not mean that they are actually charging interest. Let me explain. If a juice shop sets up across the street from a pub and decides to price all of its juices in line with the price of beer across the road, is that juice permissible to buy? Of course it is. Just because the price of the juice is tracking the beer price does not make the product itself haram. Ah, Ibrahim, but they're not just using Sonia terminology, I hear you say. They actually price up the Islamic mortgage using Sonia. So it's not just price tracking, but actual interest involved. However, even if a bank was borrowing on interest and then offering us a halal mortgage, that would actually, from an Islamic fiqh perspective, be acceptable for us, though haram for them to do, of course. The reason is because our transaction with them is separate from their other affairs. It's separate from where they get their money. Just like we don't have any issues buying and selling halal stuff from someone we know also makes an income from haram sources, there is no shari'i problem here either. Like otherwise, we would have an issue with every Muslim newsagent who's trying to serve a chocolate bar to a Goldman Sachs banker, right? That is not an issue. And the same situation applies here as well. Having said all of that, actually the vast majority of Islamic banks, to the best of our knowledge, actually get their money through Islamic savings accounts and use that to finance the homes, to the best of our knowledge. Now, whilst we're very supportive of Islamic mortgages, we do also recognize that they're not quite perfect. And here are three, we think, pretty valid concerns or arguments that people could have with Islamic mortgages. Firstly, Islamic mortgages don't share in the ownership risk adequately. Secondly, the contract itself does not use local rent values, it uses some kind of base rate equivalent. And thirdly, Islamic banks create money just like normal banks do, and that is bad for the economy. Let me unpick each of those points. Islamic banking is supposed to be a fundamental paradigm shift from lending to an individual where he is exposed to all of the risk of the venture and where the bank simply takes its fixed return, to a setup where the bank is seen as much more of a partner in the venture and consequently shares in the risk associated with the house. However, three things seem to contradict this point. Firstly, Islamic mortgages, at least those that are available in the UK, ask the buyer to take out the house insurance on the house so that everyone is covered in the case of an alien ship deciding to land on the house, for example. Secondly, the Islamic bank also asks the customer to maintain the house and make sure its general upkeep is done, usually called a service agreement. Now, if the Islamic bank owned 80% of the house, say, then a common sense understanding of house ownership and partnership in a business would suggest that costs are split 80-20 when it comes to home insurance and upkeep. But that currently doesn't happen with most Islamic mortgages available in the UK. Thirdly, Islamic banks do not fully expose themselves to the vagaries of the open market. When you become a partner in a taxi, for example, and you both invest 50 quid each, let's say your partner gets you to promise you will buy his share off him at 50 quid in a year's time, regardless of the then value of the taxi. Given this locked-in pricing, your partner is in effect not risking very much. He certainly isn't risking a loss. In Islamic mortgages, this locked-in pricing happens in the quarterly or 6 monthly or annual buyback of a stake in the house. The Islamic bank has already agreed with you from the start that the house will be sold to you bit by bit at the same price as that you bought it at right at the start of your mortgage. This, in effect, helps you out because the house prices mostly rise. So if the bank was actually to work out the market price for its 80% share, you would end up paying a ton more over the period of the mortgage. But of course, sometimes, very rarely, things can go in the bank's favor. Let's say you want to sell the house and the house price has actually fallen below what you bought it for. So let's say you bought it for 200,000 and you owe the bank 160,000. Unfortunately, the house is now only worth 150,000. Now, in this situation, the Islamic bank can say to you that if you really want to sell this property, then you need to pay us back entirely because we don't want to sell at a loss at this moment in time. So you can see it from a bank's perspective, to be honest, that if you're the one who's deciding to sell when you're in a loss-making position, then that's kind of on you, and they have their own investors to answer to. So if you do sell at that point, you shouldn't be putting them in a difficult position. So pulling it all together then, are Islamic banks being complete scumbags when they're not contributing to insurance or the upkeep of the house? In our view, it's completely understandable for them to not do that. in order to align with what the practices of the wider conventional banking industry is. Now, I think it is a nice thing, it is a form of ihsan for the Islamic finance industry to have a different model. And this is why I really like people like Way Home and Primary Finance and others who have innovated on this, and they actually do contribute in to some extent to some of the partnership-like expenses that come up in house ownership. But even these guys, to be fair, they do have to be commercial about what they do. So there is going to always be a bit more of a burden on paying for these sort of things for the homeowner. And I think that's pretty fair all in all. And we're also really happy to see people like StrideUp come along and offer a product where, as part of that Islamic mortgage contract, they will actually literally own a portion of the house where they have an equity interest in it. So this is not just a banking equity interest where they're selling that stake, they actually have an equity interest in the house. And that's really cool because it helps align interests in a deeper way with those who are going to be living in that house. The Islamic mortgage uses SONIA pegged values to work out rent instead of trying to work out what the local rent would be for a particular property. This is not ideal. However, two important things have to be said in defense of this. Firstly, Islamic banks that did try to not peg things to the rate found that they were taking up precious time negotiating on rental rates unnecessarily with their customers. And given that they're not in the business of being an estate agent or a landlord, they really want to avoid this. Secondly, it will be quite a task to quarterly or biannually work out new local rent rates that are accurate for the thousands of mortgage properties that a bank will have on its books. So from a practicality perspective, this would be extremely difficult to implement. So this is a nice to have, but doesn't impact the Sharia analysis in our humble view. This issue, I feel, is often one that slips under the carpet, as most people discussing Islamic finance often do not have an economics background. Unfortunately, the reality is today, our money supply, 97% of it is created by private interest-dealing banks who simply pop money into existence. They have the right to print money legally, and that is bonkers. Now, we've spoken about this in a ton of other videos, so I won't discuss it here and repeat myself. Islamic banks, unfortunately, also operate in this system. This does mean is that Islamic banks are also essentially creating money out of nothing. Now, this arguably goes against the well-established Islamic principle, لا تبع ما ليس عندك, do not sell that which you do not have, and raises all sorts of major macroeconomic problems as well. Suffice to say that fractional reserve banking screws up the economy, causes inflation, and puts money supply in the hands of an unelected elite group of private bankers. Now, UK Islamic banks who rely on savings accounts and current accounts also operate according to these practices, and this is another serious problem, in my view, with Islamic banking as it is today. Now, this is also a macro problem that really can't be easily solved, and what I'm not saying here is for Islamic banks to unilaterally try to solve that, particularly in the West. I think in the Middle Eastern countries and Muslim majority countries, solutions can potentially be created much more effectively because the central bank, hopefully, is much more supportive of the Sharia. So what is the solution right now then for us? Well, the simple solution to this is to get large funds with patient capital to invest hundreds of millions into Islamic mortgages instead. So rather than conjuring up money through a sleight of the hand using savers deposits, instead Islamic banks can just use hard actual cash from pensioners and awqaf. Okay, so far we've spoken about the types of Islamic mortgages that exist. We've looked at the Shari'i analysis for some of them. We've looked at some of the bad arguments against them. We've looked at some of the good arguments against them. And we've also pointed out some of the real life issues around Islamic mortgages as well. Now, let's talk about what halal mortgage products are currently on the market. For this section in particular, our experience and expertise mostly rests with the UK, so that's where we'll focus on. In the UK, before we get into actual Islamic mortgages available, there are a number of other products that you should be aware of that can either help you get a mortgage quicker or are a different type of mortgage or a different way of buying a house. As far as we know, unfortunately, no Islamic bank is currently offering assistance with an Islamic mortgage for a right to buy scheme property purchase. A right to buy, for those of you who are wondering, is where the council allows you to buy the house that you've been living in for many years at a substantial discount. But unfortunately, not many providers want to provide financing on a house like that. For those of you who are interested in commercial property and buying for investments, there are several Islamic mortgage providers in the UK who offer a buy-to-let mortgage. These include people like Al Rayyan, Gatehouse, Al Ahli. Buy-to-let Islamic mortgages are also particularly appealing because they don't have an early repayment penalty. That means you can quickly pay back a big chunk of the mortgage and dramatically reduce the monthly repayment amount. With conventional mortgages, you can't always do that, so without having to pay hefty fees on it. So this works out quite well for people who are looking to invest, or expats who often go abroad for a number of years, earn their money and come back and want to put in a big chunk of their money in one go into a particular property. There are also now a growing number of companies in the UK that are trying to challenge conventional and Islamic banks by catering for those customers who may not necessarily qualify for a full Islamic or conventional mortgage. So for customers who may not have worked for 6 months in a permanent job, or who are self-employed without 3 years worth of accounts, or for whatever other reason are more interested in breaking out of the traditional banking world, even if it is the Islamic banking world, these alternative companies can be really useful. Typically, they do tend to charge a little bit more, as the way that they're usually structured is that they're taking an equity share in the house alongside you. And of course, this is an even smaller industry than even the mainstream Islamic banking sector. So amounts that they're going to be charging will be relatively high in most cases. However, that is not always the case, because particularly in these high interest rate environments, actually, if these companies are charging rental rates, it can actually end up being a little bit cheaper even sometimes. Having said that, you do need to think about things in the round, because a number of these companies are not regulated, so you don't necessarily get the protections that come from being part of a regulated investment product or financial product, and they also don't benefit from the stamp duty exemption, so that you might have to end up paying double stamp duty. So that's again something to consider and make sure that you've thought about as part of your wider calculations. Phew! That was a lot to get through, but we're finally into the final stretch, and you'll especially want to hear about this stuff. What are your actual options? Again, we'll be mostly going through the UK products, as that's our forte, but hopefully we'll go through more options globally in other videos. If you're looking for a HPP, Islamic mortgage, then you have basically two options at the moment. With a HPP, you basically have either Gatehouse, and ever since Al Rayyan left the market, the only other ones really available on the residential side is Stride Up. Al Ahli come in and out, and there's some other people who, if you're buying very large houses, can potentially help you out. But basically, you've got Gatehouse or Stride Up at the moment. And a quick note on Stride Up, folks. So they're a company that we've invested in from our investment arm, and actually we've now partnered with to offer other types of investors who want to invest in a fixed return, an investment into the Islamic mortgages themselves. They're a relatively young company. They're already deploying, and they've financed a number of homes already. They are a regulated platform, and we've known the guys behind it for a number of years now. Good guys. Now, let's move on to our second alternative type of a conventional mortgage, shared ownership. So for folks who are listening carefully, this is what I referred to as an alternative to a mortgage before. So this is the same conversation. Starting off, we have Halo Housing. Halo Housing is an alternative to a mortgage, provides a shared ownership model where you can buy back as much or as little of your house as you like. Generally, they are the most suitable for those who are otherwise struggling to get an Islamic mortgage with a mainstream Islamic bank, because Halo's rates tend to be more expensive and they tend to go up with inflation, so not necessarily as worth it if you can get yourself onto an Islamic bank mortgage instead. From a sharia perspective, they're very straightforward, as they don't lock you into buying back anything on the house, and as such there isn't any debt-like element to the structure at all, which arguably some people say there is with a standard HPP mortgage. Then you've got Wayhome. Wayhome, by the way, a company we've also invested in through our VC fund, formerly called Unmortgage, provides a shared ownership model. They're a well-funded company like Halo, and we think definitely worth checking them out. They do cap you out at owning 40% of your house, due to tax reasons. But for most people who are buying their first house, you will most likely end up selling that well before you own 40% anyway. Next up, you have FIDA, formerly known as primary finance. In a nutshell, they too are an alternative to a mortgage provider, and they provide a shared ownership structure, but they believe that they can offer such a structure at Islamic bank or lower rates. And so far they have pretty much delivered on this, especially with Islamic rates becoming higher with a higher interest rate environment. Where the jury is still out is if they can secure the major funding to truly scale their excellent product to the next level. And last but not least, don't forget the local council or other developers that may be developing sites in your neighborhood. You may be able to get financial help from the government to buy a home or the local council to buy a home. This could be through some kind of shared ownership structure or through some kind of partnership with a housing association. All of these agreements and arrangements do vary from entity to entity and local council to local council, but there are a bunch of them out there, so do make sure you keep your eyes peeled and take advantage wherever you can. Usually the criteria for these kind of schemes is that you can buy a home through them if you earn less than 80,000 a year as a household, and any of the following apply. You're a first-time buyer, you used to own a home but you can't afford to buy one now, or you're an existing shared owner. If you want to find out more information, check out the government website, check out your local council website as well, and you'll find a lot of information about the options that are available for you right now on there. Now, for our final alternative to a traditional mortgage, crowdfunding. This is similar to the shared ownership scheme, but with some key differences. Here, the buyer purchases his share of the property. The investors, who are a number of people that come together from the public, have crowdfunded money to also own a share, and the investors will receive rent for the part that they own from the buyer. In contrast, in the shared ownership scheme, rather than having loads of investors, you'll just have typically one developer, one council, or one company that you're having to deal with. Here, through an SPV, there's lots of people who have a stake in the property. There's only one real option that we are aware of at this particular time, and that is Crowd to Live. Crowd to Live is a property crowdfunding platform that does exactly what we just described. They are also FCA authorized. The key USP that Crowd to Live have is that with just a 5% deposit, you can actually get yourself onto the property ladder, which is often very appealing to people who are just starting off on their home purchase journey. Crowd to Live are still pretty early in their journey, and I'm sure there will be ups and downs on that journey as well, but one to keep an eye on, and they're doing some very intriguing and interesting stuff. If investing in Islamic mortgages is up your street, then do check out Crowd to Live, and do also check out the Curate fixed income fund, which is a slightly tweaked version of the same kind of strategy. Fixed income fund will typically offer you a slightly higher return, because what we've done there is we've blended in another kind of investment into the fund as well. I won't bore you with the details of how we do that. There's another video for that at some point. The link is in the description below. You can find out more there. Now that you know what's around, what do you typically need to get yourself an Islamic mortgage? The main barriers people face to getting a halal mortgage in the UK are the following. They are looking for too expensive a property. Usually Islamic banks only offer ×4 or ×4.5 of your annual salary as an Islamic mortgage. The deposit you have to provide would make up the remaining amount of the property price, which brings us on to the next thing, because if you don't have a sufficient deposit, that's a deal breaker. And bear in mind, you might have enough for a 5% deposit, which will get you into the door at some banks, but the size of the house you're looking for might mean that overall, your monthly repayments are so large that it just wouldn't be affordable. Another issue is if you are self-employed. Islamic banks and mainstream banks often can ask for up to 3 years of annual returns of your company before they are comfortable that you can pay for your Islamic mortgage. Another situation is if you have been employed for less than 6 months or are on a probation or in your notice period. Islamic banks want to finance people who are in a stable job. Another problem situation is if you are buying a renovation property so badly dilapidated that a bank can't finance you under the residential Islamic mortgage for that. You'll have to explore other options like bridge finance for that kind of thing. Another big problem can be if you have a bad credit history. The reasons for that are pretty obvious. So if any of those aren't you, then you're in luck. You might actually be able to get yourself an Islamic mortgage. Folks, that was a very long video, but we got there in the end. Thanks to the 5 people who are still watching this. I'm really keen to hear your thoughts on this video in the comment section below. What did you find most beneficial, and what would you like us to expand on in the future? Until next time, Assalamu alaikum.